Hello and welcome to BISP Sol. Hello and welcome to BISP Solution. We are going to continue um, QuickBooks desktop learning sessions along with the US GAAP and with the IS and IFRS. So we are going to discuss about the multi-currency features. So Mr. Gabby, a good accountant of Mr. Dawson, who is the owner of Dream Multi Enterprise Inc, asked about that whether you are having a customer or a vendor, or you are going to deal or transacting in your sessions about the multi-currency. So Mr. Dawson said yes, he is going to be needed. The transactions. Okay, that is more than one currency transactions. Okay, so Mr. Gabby told him that you are going to need to learn about the QuickBooks desktop multi-currency features, along with some standards and policy which are there for this type of the transactions. Okay, so Mr. Gabby told him that he has to listen he has to listen careful to understand how does the transactions will done. And Mr. Christopher Dawson has already done some transactions with certain vendors and customers. So along with it, Mr. Gabby will told and record those transactions. So here we are. Sometimes we must pay or get to paid in more than one currency. The currency of the country that the business is registered in, it's called the home currency. So the home currency is the dollar. Okay, where the business is registered. Suppose you have registered in some other country like Great Britain. There is Great Britain pound is the home currency. So where is the business is registered, the country where the currency is called the home currency. So most other transactions will be the home currency. So it is a common that we are going to use that home currency where the company has registered. So Mr. Gabby told him that IAS 21, the effects of changes in foreign exchange rates, is applicable for this multi-currency features or foreign exchange rates. So what does this standards allow you? So Mr. Gabby giving him a brief that this standards outlines that how you will deal with foreign currency transactions and operations in your financial statements, and how to translate those financial statement into a presentation currency. Presentation currency here means the home currency in which we are going to prepare. It can be another currency, but right now we will just take this presentation currency will be the home currency. Okay, so the entity is required to determine a functional currency for each of its operation if necessary, based on the primary economic environment in which it operates, and generally records foreign currency transactions using the spot conversion. We are going to see what are the rates we are going to convert it at the end of the period, or when we are at the time of the transactions, or etc., or at the closing of the financial statements. Okay, so Mr. Gabby told him that there are certain definitions like he told him that the functional currency. What is the functional currency? Functional currency is the currency of the primary economic environment in which the entity operates. It means, suppose you are registered in USA, but your whole operation, primary economic environment is in the Canada. So you have to deal in the Canadian dollars, not in the US dollar, because you are doing all the functional transactions in Canada. You are just operating from here, not doing anything here. Presentation currency are those currency in which you are presenting your financial statements that are presented. Okay, so it also tells the exchange difference. Exchange difference is that difference where occur when you are dealing in the multi-currency. So the exchange difference is the only difference here, whether you are gain or whether you are getting loss, because of the different part of different types of currency. Different types of currency is moving upwards or downward as compared to dollars, because dollar is a base currency, so we will always deal with the dollar with the other currency. Foreign operations, that if you are having any associate branch outside in a country or other than a reporting country, reporting entity. So this is the certain definition which Mr. Gabby explained to Mr. Dawson, but yet Mr. Dawson is unable, so he will be showing some examples and will explain further. So when QuickBooks displays the results of transaction in another non-home currency, the resulting numbers are displayed in the home currency equivalent amount of home currency. So with this, what do you mean by this? It means that the QB displays only the transactions with another non-home currency, but it is resulting in the home currency. So it is converted into dollars, then it will display you in the dollar currency. Okay. So he said that please explain it. So he is explaining with some examples. Like suppose if you are having 200 Australian dollars are equal to 1 US dollar. Please, I am just taking an example to make you understand more efficiently by taking a simple examples. Okay, I am not using any currency, it's just an example. Okay, so if 200 Australian dollars are equal to 1 US dollar, what is US dollar is a home currency. Okay, so it is a home currency, that is a functional currency. So then we record receiving 2000 Australian dollars. Okay, if we are receiving $2,000 from a customer, that is Australian dollars, but the Australian dollar rate is 1 US dollar, so we are receiving only $10. It will divided by, okay, so QB will displays only $10 as the amount of the transactions, whether we will add or subtract $10 to the accounts that the record transactions. Okay, so let's assume another, that's if it was 2000 Australian dollars as earned, the income account would be increased by $10. Okay, if it was paid, as delivery expense, suppose we are paying to a vendor, then the bank account will be lower by $10, but the delivery expenses will be increased by $10. So you can see there is a differences. Okay, so now so Mr. Gabby move forwards and explain some more about the IS. Okay, so he tells the foreign current transactions. So a foreign currency transactions should be recorded initially at the rate of exchange as the date of the transactions. Use of average is permitted if they are reasonable approximation of actual. So it means that suppose you are initially recording a transaction at that date when the transaction occurred, but if you are not receiving at that time or you are not paying at that time, but the exchange rate is changed, so there will be comes up the difference, whether it is a gain or loss. It means that all the exchange differences will be gone to the profit and loss accounts. Here you can see at each subsequent balance sheet date, non-monetary items, that is fixed, you can see foreign currency monetary amount should be reported using the closing rate. Okay, it will be a closing rate, but the non-monetary items which carried at historical cost, should be reported using the exchange rate at the date of the transaction. Non-monetary items carried at FV and reported at that existing. So exchange differences arises on when it will be go into financial statements in the period. So he says, so Mr. Gabby also explains certain more examples about the translation from functional currency to the presentation currency, and it will be a disposal of a foreign operations. It can be disposed of. Okay, so now Mr. Gabby explain another example टू मोर. ठीक है, सपोज द डे दैट वी रिसीव द 2000 ऑस्ट्रेलियन डॉलर्स, दे वर्थ और $10. Okay, but or before that, that it means that dollar changes as the currency changes. Of course, when the currency changes, of course the dollar also changes, so the problem will arise how to adjust the amount, so that sometimes the dollar goes up and the other currency goes down, and so on. This become an issue if we receive the other currency on day one and then transfer to pay that currency on another day. On the day we pay with that currency, there will be a different value of the currency from the day that we receive the currency, as these are, so the differences will go here in the profit and loss account, as Mr. Gabby told you while explaining you the foreign currency transactions. Okay, we will just take an example. Suppose on the day we received the 2000 Australian dollars, which was worth of $10. Okay, suppose we are receiving today, and the Australian dollars is of $2000, that is worth of $10. Now on the day we pay them, so we pay them to a vendor for a service, these same Australian dollars are only worth of $9. So you can see there is a change. Therefore on the day we pay out these Australian, we have lost $1 because of the constant changing of the exchange rates between the dollar and the other currency. Okay, so it means so you will understand like this. Suppose for a customer of Australian dollars, we have create a invoice for a customer is in Australia for a $10. Okay, we are going to receive $10 when we create an invoice, and then the same customer is pay in the next day, but the dollar is increased to $11. Okay, so this is the difference between, we are getting $1 gain when we create invoice and we receive the payments. Suppose the customer gave us a check and we will transfer it to undeposited funds account, and when we make deposit, the dollar is increased by $12. So you can see we will get another $1 of gain. So this is how the gain and loss works while there is a constant changing of the exchange rates. Okay, it can be like this. Suppose we create an invoice of $10, but when we receive a payment, we will got a $9 rate. When we deposit it gone to 8, so we will getting a loss of $2. This is same happen this when we do this. Okay, so how does QuickBook handle this? For each consecutive transaction with the non-home currency, QB will record the transaction at the current rate of exchange. Each of these consecutive currency transaction will be recorded with an additional adjusting journal entry that QB will make automatically to record the gain or loss from the difference exchange rate. Okay. So there is two types of transactions, that is transactions that are converted at the moment of the transactions, and the transaction physically made by receiving, paying or transferring the second currency. Okay, so now before we move there, we will activate multi-currency. Before we can record transactions with more than one currency, we must activate the multi-currency feature in our QuickBook desktop. Okay, this means we go to preference window and turn it on and see what happens then. Okay, so Mr. Gabby takes Mr. Dawson to the QuickBooks. So here now when we activate the multi-currency feature, you will see on the list option first, you will be able to see here multi-currency list here where we can add more than one currency. And yes, of course, when we go here on the report options, you will see on the companies and financial, here you will see realized and unrealized gain and loss account as well. Okay, as well we will go to the customer center and we will see here, when we just click here, the window will come up here about the currency of that customer. Here it will also show the currency sign in which that particular customer we are dealing with. Same as to the vendors as well, there will be a currency sign will come up here when we activate it, and many other window will come up here. Okay, so remember, when here from the preference window in the multi-currencies options, the company preferences, it is track multiple currency. In this company file is single file, so we are using only one currency. And if we click this, let's see what does it say. It say you are about to turn on multiple currency. Before you do, read these important consideration. The summary of this consideration is that when you turn on the multiple currency option, you will not going to turn it off. Once it is turned on, it will be turned on, it will not be going to be turned off. So be careful, if you are not using these functions, you will not going to turn it on. We click yes, and now you can see the select the home currency. Suppose your home currency is changed, you will change it from here, from view more currency as well. Right now we will leave this and we click on OK, so it will open, so this application will get started. Okay, okay, sometimes the the application not work properly, we have to restart it. Okay, it will take hardly a minute. So here now what I'm saying, that you can see that currency list option is comes up for the first time from here. Here you will see on the reports option under the companies and financial, you can see the realized gain and losses, unrealized gain and losses. This report will comes up, and from here I am telling you the customer, here you see the option is comes up here. Okay, so what multi-currency list addition or activated adding additional currency? Okay, now we will move forward. Okay, okay, now suppose we are going to add the currency list. Here you will see this, there is many currency are available, but many are inactive. Now you can see only 4 currency QB defaulted. Some currency like the Canadian dollar, euro, Japanese yen and US dollars are there. These are not these are active currency. Okay, if you want to active more currency, you click on include inactive currency. You just check it if that currency is available or not, or you can just click on new currency and add that. Okay, suppose we want we want Australian dollars to be inactive, to be active. So now you can see the Australian dollar currency is active as well. Suppose you, and here you will see this. Okay, now another currency you want to record it, you want to activate that, the Serbian dinar. Okay, you'll just activate these currencies. Okay, now you can see your 2 currencies, Serbian dinar and the Australian dollar is active in the currency, and you can see on the opposite side that there is a code AUD for Australian dollar and RSD for the Serbian dollar. Okay, now we will go and add the customer and the currency for that customer. Okay, It means that for each customer we add to QuickBook, we must tell that QuickBook which currency that the customer will pay you with. Of course, you have to tell the applications that this customer is going to pay you in this currency. Only customer who pay us with active currencies, you have to first active the currency while adding, before adding any currency to the customer. Okay, will be able to be saved in the customer list. Simply choose the currency when we first input the new customer. Okay, so it means that one currency is for one per customer. Okay, so now we will go to the customer center and we will add the customer. So we'll add new customer, and we have examples. We will add customer Alistair Root from Australia, and we add Andrew Cook from Serbia. So the first is Alistair Cook. So Alistair Cook is going to pay us in Australian dollar. Okay, we will just leave this blank. Okay, we will click OK, and here. Okay, and we will add another customer, that is Andrew Cook, and Andrew Cook will be going to pay us in the Serbian dinar, and we click on OK, and now here. Okay, now you can see when we are going to do the transaction, there will be a sign of the currency. Okay, so now we added the two new customer to a customer list. We will add two new vendor as well, that is vendor Alice Simpsons from Australia and Heli Shah from Serbia. Okay, we will go to the vendors again. Here on the vendor list, we will add a new vendor. We will write Alice Simpson, and he is from Australia, and we are going to pay him dollars with Australia. We click on OK, and we will add new, and it will be a Hali Shah, and she is from the Serbian, and we'll click on OK, and we just added two new vendors. Okay, so now after this we are going to see how to invoice and how to bill and receive payments from the customers first. Okay, sometimes we have customers that require that we will bill in their own currency from some product or service we deliver. We can invoice or bill any customer in any currency that we have activated and assigned to that customer. Okay, they can pay from pay platforms that can convert their currency to dollars. We have two types of multi-currency transactions. The first one is that the transactions that are converted to from the home currency at the moment of the transaction. In this, there is no fee to transfer currency before receiving payments. We will see how to handle the fee. We must download the current rate of exchange for that currency before recording a transaction in that currency. This will establish the initial value, that is the starting value of the currency for any future gain or loss. It is the exchange rate on the day of the first transaction. We will input the transaction with the number of units in the other currency. The amount that QB record into our accounts and customer or vendor record are the dollar equivalent of the amount of the transaction. It means that whatever we are just creating invoice in another currency, but the QB will automatically records in the dollar rate in the dollar currency by understanding the exchange rate on recording on the day of recording the transactions. Okay, so we will do some examples to understand, because Mr. Dawson is already create some invoices and receive payments there. So first we have to go and download the currency. So how we will download? We will just click on the currency list, and here on you can see that on the activities, download the latest exchange rates. So if you are you have to download it every day, or you can download it weekly. So you can see that this is the currency. So US dollar is one, is because we are just dealing in US dollar is a home currency, and we are dealing in another currency. Okay, so now Mr. Dawson told us that on 1st March 2024 he did financial services for Cook, and he must invoice him in Serbian dinar. He agreed to pay 10,000 dinar in the future for the services, and the exchange rate on that day is $1 is equals to 0.01337 per dinar. Okay, so Mr. Dawson, Gabby told him to create an invoice. So we are going to create an invoice, and you will see there will be an effect in the trial balance as well. Okay, so on the customer we create an invoice. Okay, now you will see many things here is changed. Suppose we are going to create the for the Alice, we have just Andrew Cook we have added, Andrew Cook we have added. We have some different name, Alistair Root. Okay, let me change the name, so it will get lot of confusion. Sorry, Alistair what? Okay, we'll click on OK. Now yeah, again we come here. Okay, so now create an invoice. As soon as I create Alistair Wood, now you will be able to see many things has been changed. The first thing, you will change the account here. QB automatically created two accounts: account receivable in Australian dollars, and account receivable in Serbian dinar. Okay, Republic of Serbian dinar. So now this is the first change you will see. So now you will select that you are dealing with Alistair Wood, and you will just click it, and here you can see I am just telling you the symbol of the currency is also comes up here. So the symbol is come up here, and now you will just change the date. Now step by step I will tell what are the changes on 1st March. Here you can see there is no exchange rate save for this currency because we are invoicing the previous. You can just click on OK and move forward. And now we will what we have done, we have supplied him services for 10,000 dinars, financial service. Here we won't wrote the quantity, we just delete this, and we will just type the amount to 10,000. And what are the here now you will see you will change the exchange rate. Here you can manually change it. Now here you will see that we are receiving 133.70 US dollar on 1st of March while we creating an invoice, but he is paying 10,000 Australian dollar. Sorry, I'll change this to Andrew Cook. Okay, here he is saying paying us 10,000 dinar, but it is equivalent to this dollars 133.70. Okay, now we just click save and close, and you will see on the trial balance. I should add here we already added the trial balance. Okay, now here you can see here you will see that the account receivable of Republic of Serbian dinar is comes up for the first time to $133.70, and on the financial income here you will see that 133.70 will come up here. So what I was saying, that the currency, the statement in which the currency is we are having is displays the report on that currency. Okay, but now if you click on here, and you will see that it is always showing in the dollars option. Okay, so now we get paid for the invoice. The day we get paid, the dinar are worth a different amount from the dinar on the day that we created the invoice. We can either download the new rate for the day we got paid, or we can input the create that we needed it to be into QB to record at the moment we record receiving the money. Then QB will record the transaction normally, but add an adjusting journal entry for the difference in the rate from the invoice date to the payment date. Suppose now on 5th of March 2024 we receive full payment from the wood for the invoice from 1st March 2024. The rate is 0.014 dinar. Okay, so how we will going to do this transactions? Here we can see there. We will just go normal receiving a payment. We will receive a payment normally. We change the date to, sorry, we will, yes, it's Citibank Las Vegas. We choose the date to 5th of March. We will change date wood. Here now you will see, now here you will see that we are just receiving 10,000 dinar. You just write it 10,000 dinar here. Here you can see it is asking you how much payment you are receiving. Suppose you are receiving lesser than 10,000, you should record it at that amount. You have to write the RSD here, and the exchange rate is 0.014. Okay, we will just click save and close, and you can see the difference. You can see the changes in the trial balance here. First, the account receivable of Republic Siberian dinar is become 0. The Citibank is increased by $140. Okay, but there is no change in that here. But now what happens here? The exchange gain, we are getting a gain of 0.063. so we will receive a exchange gain or loss of $6.30 because of constant changing of the exchange rates. Here comes up the standard which I explaining to you, that while recording the transaction date on closing day, if there is an increase of a certain currency, we will get a gain or we will get a loss as well. Suppose if we are paying him in the lesser amount, then this amount will be debited and we will having a loss. Okay, so now the second transaction, we have just learned the first transaction and we are going to know about the second transactions. Okay, so what is the second transactions? Fees for exchange deposits. In this second example, the payment we receive from the cook will be directly deposited into the bank account. However, if we need to deduct an exchange fee, we need to make an intermediate step. We need to record the full payment into undeposited funds. Then with the same date, record the payment as deposited in the deposit window. That will give a chance to deduct fees. So what does this means? It means that suppose example, suppose on 10th of March we did legal services for cook and we billed him for 10,000 dinar. Each dinar was $0.013 on this day. but on March 15th of day he pays all 10,000 dinar. The dinar is only worth 0.012 of the dollar, so we are getting a loss of 0.001, that is the $10 on exchange. But they are adding also adding deducting a $20 fee for the exchange and the transfer funds. That is, they are also charging 1,000 dinar for the deduction fees. So how this transactions we will do? So we will handle this transaction. First we record the payment into undeposited funds, then we will open the deposit window and deduct the fee and record the net amount, and then we create okay, now we will do, okay, so first we will do the two transaction. First we will create the invoice and then we will receive the payments. Okay, so on an application, again from a customers, create invoice, we received from Mr. Cook. Okay, we'll check this. Okay, the item is receiving legal services, we just delete this, and the 10,000 dinar. Okay, the exchange rate on this day is 0.1013. okay, so we are just creating invoice. We are going to get $130 whenever he is going to pay. We will select okay, we just change the date. We change the date to 10th of March. Okay, yeah, we added a $0.013, so you can see that $130. So Mr. Dawson is expecting that Mr. Cook is going to pay him $130 when he is going to receive the payments. So we'll just, so okay, we will do that. We are receiving a payment on 15th of March. Okay, 15th of March we are getting payment, but the payment is going to be undeposited funds. He is going to give us a check. Mr. Cook is going to give us a check of $10,000 dinars. Okay, the check number is 654753, and the exchange rate is come down to 0.012. You can say the dollar currency is loosen up, or you can say that Republic of Serbian dinar is tighten up. Okay, so you will just and you, so you are receiving $120 instead of $130. You are getting a loss of $130. So when you click save and close, for that instant, for these two transactions, you will see that you are getting a loss of $10 and the net amount will comes up $3.70. Okay, so now here you will see that on undeposited funds account you are getting a $120. Okay, so it means that you are receiving $120 on undeposited funds account. So now before I move forward, I will explain one thing on the reports function. Now on the reports function, I told you about the realized gains and losses. Here you see the realized gains and losses, that while receiving realized amount of NTU Quick is 140 and the unrealized amount is 120. That is on 15th March. You can see when you are receiving a payment, it will show you the realized gain and it will give you the net effect, and you can see the you can see the exchange rate when you are receiving the payment, so it and the realized amount as well. So it will be a clarity to see which amount and at what rate we are receiving in the dollars term I am talking about. Okay, so now you will close this and now you will make deposits. Okay, now you will go on the banking option and make deposits. Suppose on the same day, okay, so it is showing, okay, we have just one, we click on the same day. But what happened But what happened? That there is an exchange and transfer fees of 1000 dinar. You have to write it. Okay, so what does this means? That you have to credit it by 1000. So you will create a new account. You can create it from here, an expense account, continue, and give the name of that account name is exchange and transfer fees. Just name this, click save and close, and write out minus 1000 dinar. We already know why we are why we are writing this amount. So you are going to deposit it, the RSD is 9000 and you receiving a $108. And when you click save and close, and you will see the trial balance. Let me make it more bigger. And now here you will see that on undeposited funds account there is gone for 0. Here you can see that we got to receive $120. Okay, we have received the $120, so it will become 0. And you can see on the Citibank we receive $108. Where here on $108 split it, you can double click it and you can check it from here. And the other you can see that there is a exchange and transfer fee of $12 is comes up for the first time. Okay, so this is how the multi-currency features done for the customers. So Mr. Dawson asked Mr. Gabby, so what does this feature for accounts payable is going to be done? So we are going to discuss about the paying or creating a bill to a vendor who is having other currency other than a home currency. So we will continue this we will going to do part 2 in the next session of this multi-currency feature of QuickBooks desktop. Okay, I hopefully you have understood about the multi-currency feature about the customer portion. So we will continue this to the next session, and thank you for joining us. Okay.